Yes, my dear student, how are you all? I hope everyone is doing absolutely fine. And right now, I know you all are busy with your upcoming exam preparation. In this video, we'll discuss all the RTP question of CA Final Financial Reporting paper for September 2025 exam. What I have found that this time in RTP, ICI has given almost all the new questions, and all the new questions are of good quality. When I say good quality, it does not mean it is difficult. Once you understood the information given the question and you know what are the related concepts, the solution is very simple. Only understanding of question and information is required. Let us start a discussion. The discussion will be in two parts. In this part, we'll discuss all the descriptive question of RTP, and the next part will discuss the case scenario MCQ based question. So the discussion will be in two parts. Before starting, if you are new to this channel, don't forget to subscribe to the channel and do share this video with all your friends and like this video. Can we start the discussion? Yes, sir. We will start with the first question, question 11. This question related to consolidated financial statement for the loss of control. Means it is of Ind AS 110. Similar question we have done, only I will say one point is added. However, that concept we have done in the class and you also know about this concept. But let us do it because new question is this. A Limited owns 100% of subsidiary of B Limited. It disposed 60% of its interest in the subsidiary for 360 million. This is the fair value of cash consideration received, and loses control of the subsidiary. Okay, sir. It will deconsolidate the subsidiary and account for the remaining 40% interest as an associate using the equity method of accounting. Of course, 40% means it will become an associate now. At the disposal date, the fair value of retained investment in B Limited is determined to be 240 million. The fair value of retained investment given. The carrying amount of INA of subsidiary is 440 million, excluding goodwill. The carrying amount of INA is given, which is required on the date of loss of control. There is 60 million of goodwill recorded related to previously acquired interest in the subsidiary. So when the control was acquired, that time goodwill was recognized, that was 60 million, and of course it will full goodwill. Why? Because 100% was acquired. A Limited tested the subsidiary's goodwill and the long lived asset prior to disposal, and there was no impairment. So there is no impairment loss for goodwill and INA of subsidiary company. There is a 4 million credit in the available for sale reserve and 10 million credit in the revaluation reserve relating to the subsidiary B Limited. I hope you know this point. Whenever there is a loss of control and if there is some OCI component related to subsidiary recognized in the consolidated financial statement of parent company, that need to be de-recognized. De-recognized means if that OCI component is of which nature, means OCI are of two types. One is recycled to PL, one is not recycled to PL. So if it is recycled to PL, then it will be reclassified from OCI to PL. If it is not recycled to PL, it will be transferred to retained earning as per respective Ind AS. So revaluation surplus as per Ind AS 16 will be transferred to retained earning, and available for sale reserve. This is the term which is for the first time used in any question. So you might be confused with this term. Now available for sale reserve, if you remember, we have done equity instrument through OCI, debt instrument through OCI in financial instrument chapter. If you remember, any investment in debt instrument, if it is hold to collect contractual cash flow and sale whenever required, it is known as available for sale investment. And any gain or loss on that particular investment will be accumulated in what? OCI component will be accumulated in separate component equity, that is known as what? That can be known as available for sale reserve. In our class we have used the term FVOCI reserve. It can be available for sale reserve. So if it is debt instrument, can I say it will be recycled to PL? So in this case, this available for sale reserve will be for the debt instrument. It is for debt instrument, and this will be recycled to PL. So I will say this is the new point which is for the first time given in any question. So you might be confused if you don't understand this particular information. Chalega. Required. Pass journal entry for sale of 60% stake of B Limited on disposal date and compute gain on 40% retained investment. Okay, very easy. So we can do with the solution given. So on the date of loss of control, what journal entry will do? We'll recognize the fair value of consideration received at 360 million. Then we recognize investment retained in an associate at fair value on the date of loss of control, that is given to 40 million. And there are two reserves. So that reserve will be debited to available for sale reserve will be debited, and revaluation surplus will be also debited. So available for sale reserve will be debited, revaluation reserve will be debited. However, this will be transferred to PL account. This will be transferred retained earning. Correct. The corresponding effect will be credited to PL and retained earning. Correct. Then we'll de-recognize INA and goodwill. So INA is how much they have given, 440, and goodwill is how much, 60. You can write on separately also INA and goodwill. Means 2 INA, 2 goodwill, that is 440 and 60, that is 500. Correct. And revaluation reserve will transfer retained earning to retained earning. What is the amount? 10. And the balancing figure will be gain on disposal of subsidiary. So gain on disposal of controlling interest, you can say 104. However, the gain is 100 and 4 is added for that available for sale reserve, which will be transferred to PL. And so this is journal entry. Now to find out gain and loss on retained investment, what you will do? What is the fair value of retained investment? That is 240, and that is for how much percentage? 40%. We need to find out the proportionate carrying amount of net asset of subsidiary company attributable to parent company. Correct. That we need to find out. So that is nothing but 440 plus 60 into 40%. How much? That is 500. 40%. 500 into 40%. That is 200. So there is a gain. Gain is how much? 40. So this is related to remeasurement gain of what? Investment retained. And of course, this will be transferred to profit and loss account. So out of this 104, 40 is related to remeasurement gain, and 64 is related to the disposal of equity share, disposal of 60% interest. Got this point? Yes, sir. You can see they have calculated the same amount. Correct. Super easy question. Any doubt? No doubt. This question is simple, understood. Then come to the next question, question number 12. In the question number 12, the heading is given Ind AS 105 non-current asset held for sale and discontinued operation. Heading is only not correct. Means, of course, the question might have been designed for Ind AS 105, but then they have not considered any point of Ind AS 105. Actually, when you read this question, you will be totally confused. If you read with the heading, actually this question is related with Ind AS 103 and Ind AS 110. Ind AS 110. But beautiful question. Beautiful question. It is quite possible when you have read for the first time by your own, you might be totally confused, because in this question there are some information which is actually not related for the solution, which is not required for the solution. So you might be confused by reading the question and by reading the solution by your own. So let me explain this question. You will be able to understand. A Limited has a wholly owned subsidiary, B Limited. Wholly owned means 100%. A Limited sales subsidiary B Limited to C Limited. Now A Limited has sold 100% equity shares of B Limited to C Limited, a listed entity, for the shares in C Limited, and end up owning 75% of C Limited shares. Means what they have done? They have transferred the 100% shares of B Limited, and in return of that they get 75% equity shares of C Limited. Got this point? Are you able to understand? Means suppose this is B Limited and you are C Limited. So I have sold 100% equity shares of B Limited to you. So it means now you become the parent company of B Limited, and in return I got 75% equity shares of C Limited from you. It means now I am controlling you, and via you I am controlling B Limited. Got this point? The scenario means if you try to understand what actually happened, let me explain the question with the what actually happened. So actually before and after situation. So before, what was the position? Before, A Limited was holding 100% of B Limited, and after what happened? After this transaction, A Limited now hold 75% of C, and C hold 100% of B. This is the position. Got this point? So actually in this case, if you see, there are two transactions from the point of A Limited. So what are the two transactions? Try to understand. So what are the two transactions in this particular question? What are the two transactions? Batao. First, can is the sale of या disposal of, better write down, disposal of equity shares of subsidiary company, disposal of equity shares of subsidiary company to C Limited, and second is what? Acquisition of 75% equity shares, means control of C Limited. Okay, in this though nothing but Ind AS 103 will be applicable on the date of acquisition. Ind AS 103 will be applicable on the date of acquisition. I need to explain this one: disposal of equity shares subsidiary company to C Limited. Okay. Now, if you see this particular case, what actually happened? Initially, A Limited was holding 100% equity shares. Then they have sold 100% equity shares to B Limited in return of 75% equity shares of C Limited. So if you see, now A controls C, and via C, via C, A also controls B. So can you see here now A has indirect control over what? B. Indirect control over B. Understood what I am saying? So here there is an indirect control. So can you say in this way, through C, A is holding 75% of 100%. So here A is holding 75% of 100%. That is 75. So if you just try to understand the substance of a form of this particular transaction, even though they have sold 100% equity shares of B Limited to C Limited, but actually eventually they have only transferred effective how much holding? 25% only, because they have retained 75% of equity shares of B Limited through C. Correct? It means, can you say what is the effective disposal? If I will say effective disposal is 100 minus 75% of 100, that is 25%. So whenever there is a disposal of only 25%, means initially I am holding 100% and effectively I have transferred only 25% of equity shares effectively, that is not a loss of control. Means, can you say this is not loss of control? Why it is not loss of control? Because through C, A is controlling what? B. So you can't see there is a loss of control. Can you say it is a loss of control? Because in CFS, can you say in CFS of A Limited, they will consolidate B right now also. Via what? See, it is nothing but a concept of chain holding. We have done in chain holding. So A controls C, and through C, through subsidiary, A also control what? B. So there is no loss of control. So can you see, it is only when I am saying disposal of 25%, it is only considered as changes in proportion of NCI. Means initially there was 0% NCI. Now NCI in that CFS, from A's point of view, the NCI in B will be how much? 25%. So can you say it will be changes in proportion of NCI. So these are two transactions. Changes in proportion of NCI because of disposal of effectively 25% of equity shares to C. I can say in this way. Understood? Means disposal of what? 25% non-controlling interest. Disposal of 25% non-controlling interest and retaining the control. And second transaction is acquisition of 75% equity shares of C Limited and gaining control, and therefore it will be accounted as per Ind AS 103, and this will be accounted as per Ind AS 110. This will be accounted as per Ind AS 110. Got this point? Means I have explained the entire question with the first para only. First para, if you have understood, the solution is very easy. Have you understood the first para? Now let us read the balance para. Okay. So this first para is interesting. Now the balance para. The balance para is designed in such a way that if you are not conceptually clear, you will not be able to understand a question. Because there is some information which is actually not required for the question. And there are some information which you need to take out from the entire information which is required for the solution. So for that, conceptual understanding is required, but it is very easy. The net asset of B Limited, prior to disposal is 10 lakh, fair value is 13 lakh. Just try to understand, whenever there is a loss of control, you want carrying amount of net asset or you want fair value of net asset, you want carrying amount of net asset. I say in the class 100 times that subsequent fair value information after date of acquisition is not at all relevant. Therefore, this fair value information is not at all relevant. They have given to confuse you. Got this point? And goodwill previously capitalized and not impaired is 6 lakh. So how much goodwill? 6 lakh. And this is a full goodwill because they have acquired 100%. So this is a full goodwill. Yes sir, full goodwill. And the carrying value of B Limited in A Limited books is 15 lakh. This is nothing but in separate finance statement. This is cost price of investment. Cost price of investment. This is PC. This is purchase consideration. The 15 lakh is PC. Means can I say on the date of acquisition, if suppose, just try to understand, purchase consideration is what? 15 lakh. Means what journal entry you would have done on the date of acquisition. If I will say on the date of acquisition, the journal entry will what? INA account debit, goodwill account debit, and 2 PC. PC they have given 15 lakh and goodwill they have given 60 lakh. So on the date of acquisition, the INA of subsidiary recognized at fair value in CFS of parent company is 9 lakh. This was on the date of acquisition. Understood? However, not relevant. I am just informing you what journal entry on the date of acquisition they would have done in CFS of A Limited. CFS of A Limited. Okay, sir. Now, at the date of A Limited, at the date A Limited acquired B Limited, B Limited profit and loss reserve was 4 lakh. So this is pre-acquisition reserve, and B has since made 1 lakh post-acquisition profit. So post-acquisition profit is 1 lakh. So INA initially 9 lakh, post-acquisition profit 1 lakh. So what is the carrying amount of INA on the date of loss of control? This question is 100% correct. It is given 10 lakh. This is 9 lakh plus 1 lakh post-acquisition profit. Post-acquisition profit means the question is correct. I'm just explaining the question. First, you need to understand question. Then only we can come to the solution. Okay, sir. Then they have given position prior to the transaction was as follow. However, can you say for this question, only this consolidated information is required, but they have given separate financial statement of A Limited, B Limited, and then consolidated financial statement. So A Limited, B Limited, okay, you can see in the separate financial statement of A Limited, 15 lakh is given. This is the cost price of investment in B Limited, 15 lakh, correct. Then they have given what? The in consolidated 6 lakh goodwill, okay. The net asset is 11 lakh. How it become 11 lakh? 10 lakh plus, it is what? It is how much crore? 1 crore plus 10 lakh. So it will be 1 crore 10 lakh, 1 crore 10 lakh. Okay, sir. Then share capital of only A Limited will come. This will not come. Then it will be 95 lakh plus 100% of post acquisition profit, 100% of post acquisition profit, that is 1 lakh. So that become 96 lakh, and of course pre acquisition profit and reserve will not come. So that will not come. This is a consolidated balance sheet. However, most of the this information is required, but from my point of view, this A Limited and B Limited information is not required. Only this consolidated balance is required for solution. If they ask CBS after this all transaction, okay sir, yes sir. But just try to understand the quality of question. Quality is excellent, excellent quality. Then the net asset of C Limited prior to his acquisition of B Limited were 3,80,000 and fair value is 5 lakh. Now we have acquired C Limited in days 103. So what will be journal entry? You only say when you have acquired this. I am coming to the first part after some time. Can you give me what can be the possible journal entry here? So INA account debit, correct. Can you say goodwill account debit? That will be balancing figure either goodwill or gain on bargain purchase. Okay. 2. Can you say NCI 75%? NCI 75%. Abhi right now we don't know fair value method or pasina method. It can be fair value method or pasina method. And 2 PC. to purchase consideration. Sorry, NCI is 25%, my mistake. NCI is 25% and PC is 75%. This is the entire information. So can you say they have given 5 lakh fair value of INA, they have already given. So 5 lakh INA will be recognized. 5 lakh INA will be recognized. Okay, sir. I'm just writing all the information in the solution so that I don't miss out any particular point. C Limited then issued shares worth rupees 17,50,000, which is the fair value of consideration given for the acquisition of 100% B Limited. Because C Limited acquired B Limited from A Limited, so C Limited will pay PC to whom? To A Limited. They have issued their own equity shares worth rupees 17,50,000, worth rupees 17,50,000, being 6 lakh nominal value and 11,50,000 premium. Means can you just try to understand what journal entry C Limited will pass for this particular transaction. Means C Limited acquire investment in B Limited. What journal entry they will do? It is the journal entry will what? Investment in B to equity share capital to securities premium. This is 6 lakh, this is 11 lakh 50,000 and investment will come 17 lakh 50,000. So investment will come 17 lakh 50,000. Okay, sir. Now if you see they have given C Limited balance sheet. So investment in B is 7 lakh 50,000 and you can see 3 lakh 80,000 was the carrying amount of the net asset. The fair value being 5 lakh will not come in the individual financial statement. Got this point? Now 8 lakh, so initially it might be 2 lakh share capital. Now plus 6 lakh, it become 8 lakh and 11 lakh 50,000 is securities premium and retained earning is worth 1 lakh 80,000. This is retained earning given. This is the individual financial statement of C Limited they have given. Understood? Yes, sir. Now the balance sheet of 3 companies given. Now just try to understand this journal entry who have done. This journal is done by C Limited. What journal entry A Limited will do? So A Limited will pass one journal entry in their separate financial statement. There is what? Sale of 100% equity shares. And can you say they are getting equity shares C Limited? Means it will become investment in C Limited. So what journal entry done by A Limited? A Limited, what journal entry they will do? A Limited. So they will do investment in C Limited. Investment in C Limited. Are you able to understand now? So they will say investment in C Limited. They are getting the equity shares worth rupees 17,50,000. So that will be 17,50,000 the fair value as on this date. And they have sold investment in B Limited. And the carrying means the cost price, the carrying amount in separate financial statement was 15 lakh. So ultimately there will be gain of 2,50,000. So you can see from this balance sheet, whatever has been given, if you want to prepare balance sheet after that transaction, so there will be 3 adjustment. Investment in C Limited will come 17 lakh 50. Investment in B Limited will be de-recognized and retained earning will increase by 2,50,000. You can see retained earning, initially it was 95 lakh, now it has been increased by 2,50,000. So correct balance sheet has been given and this is the individual balance B Limited without any changes. You can see this is without any changes, means B Limited balance sheet will be without any changes. So changes will be in the balance of A Limited and C Limited in the standalone financial statement. Got this point? Yes, sir. Means can you see in the A Limited now there will be investment in C Limited and in C Limited there will be investment in B Limited. Okay, sir. Okay, sir. Now parent A Limited had an interest in B Limited that cost rupees 15 lakh, already I have said, and has in fact swapped for an interest in C Limited group. That only I have explained. Ki investment in C Limited will replace investment in B Limited. Okay. In his separate financial statement, A Limited state his investment in C Limited group at a fair value of consideration given at 7,50,000. Means this para is nothing but this journal entry. Okay, sir. Yes, sir. Are you able to understand the question? Yes. First, to understand the question. Then NCI interest determined with reference to proportionate share of acquired C Limited net identifiable asset. Means NCI is measured at Pasina method. So what will be the NCI? You only say. So NCI will be 5 lakh into, it will be 5 lakh into 25%. So 5 lakh into 25% means 1,25,000. 1,25,000. This you have understood? Yes, sir. Correct. Then what is required? Required compute a gain or loss on effective disposal of B Limited. Effective disposal means 25%. And compute goodwill on acquisition of C Limited. Note, C Limited is not required to prepare CFS. So C Limited is not required to prepare CFS. It might be exempted from consolidation. You know that intermediate parent company might be exempted from CFS. Ignore the possibility that transaction could be classified as reverse acquisition of C Limited by Limited. Means ignore the concept of reverse acquisition. They are saying ignore that concept. We'll ignore it. Okay, sir. Question is what? Question is what? Paramatma means whatever question is said, that only we will do. Okay, sir. Yes, sir. This is the entire question. Now let us come to solution. First, comment me, have you understood the question or not? First, to understanding of question. If you do not understand question, solution become difficult. First, have you understood the question or not? You need to comment in the comment box. Okay, sir. Now let us come to the solution. Now just try to understand. First, I will do journal entry for this. Then I will come to the journal entry for this. Now, you only say when they have acquired 75% of equity share of C Limited, correct? So they have acquired 75% of C Limited. In turn, means they have acquired 75% C Limited. In turn of that, how much consideration they have paid? So consideration is not paid in cash. Consideration is paid in the form of, can you say B Limited? If B Limited has been sold, means from A Limited point of view, we have sold B Limited and we have acquired 75% of C Limited, correct? But effectively we sold how much? 25% of B Limited. Are you getting what I am saying? Because in CFS, can you say this 25% will now become NCI? This 25% will become NCI in CFS of A Limited. Are you able to understand? So what actually happened? Just try to understand as per substance of a form. We acquired 75%. We acquired 75% of C Limited, correct? And PC is paid in the form of what? Sale of investment. Sale of investment, we can say sale of investment is sale of business, you can say. Sale of business of B Limited, but 25% effectively. Now you only say this PC will be what? This PC will be what? There is a 25% of business of B Limited or not? 25% of business of B Limited or not? You only say. Are you getting what I am saying? Are you getting what I am saying? You don't be confused that this PC, of course, purchase consideration is for acquisition of 75%. Means we acquired 75% C Limited. But we are disposing of, means this is non-monetary consideration transferred. Means the PC is not in the form of cash. We have transferred B's business, but only to the extent of 25%. Means PC is 25%. PC is 20. Means you don't say this is not 25%. These both are related to what? C Limited. Means we acquired 75% and the non-controlling interest in C Limited is 25%. Means this is NCNC. So don't be confused with this 25-75. Are you getting what I am saying? So once again, what they have said, we acquired 75% of C Limited and in consideration of that, we have sold 25% effectively the business of B Limited. Means in consolidated financial statement, will you de-recognize all the INA and goodwill related to the subsidiary B? No. Can you say, because that is not a loss of control. That is not a loss of control. But can you say for B Limited, now out of 100%, effectively 25% will become NCI. 25% will become NCI. Means it is as simple as the PC for the acquisition of 75. PC for acquisition of 75% C Limited is nothing but 25% of business of B Limited. Now, what is the value of this business? What is the value of this business? That we need to find out. What is the value of, what is value means fair value? Fair value of business of B Limited, that we need to understand. What is the fair value of business of B Limited? That we need to understand. So batao, you only say what was the total fair value of business? So total fair value of business was 17,50,000, because for sale of entire 100% you are getting equity shares worth rupees 17,50,000 from C Limited. It means the fair value of business of B Limited is 17,50,000. The total fair value is 17,50,000. Fair value means total. This is the total fair value of business of B Limited is 17,50,000. Means I can say this is nothing but INA plus goodwill. This is nothing but fair value of business means what? This is nothing but this is INA, fair value of INA plus goodwill of what? B Limited. As on this date, this is as on this date, 17,50,000. So we have sold 25% of this. So into 25% is my PC. 25% is my PC. 25% of business is PC for acquisition of 75% of C Limited. I hope you are understanding. Got this point? Yes, sir. So 17,50,000 into 25% is 4,37,500. So this will become 4,37,500 and goodwill will be how much? That is plus 1,25,000 minus 5 lakh, that is what? 62,500 is the goodwill. This is the second transaction. Have you understood second transaction? If you have understood second transaction, now I can come to the first transaction. Have you understood the second transaction? Batao. Now let us understand the first transaction. Now coming to the first transaction, that is effective disposal of 25% interest in B Limited. Okay, this is nothing but changes in proportion of NCI, and if you remember when we have done changes in proportion of NCI as per India's 110, the journal entry was what? Cash or bank? Account debit to NCI, and the difference will be transferred to other equity. The difference will be transferred to other equity. But in this case also, can you say that consideration received is not in cash? So consideration whatever we have received, that is in the form of non-monetary consideration. So once again, this is actually non-monetary consideration. So we can write down cash or bank. So I need to write down non-monetary consideration. Let me write down what I will explain this part first. Let me write down cash or bank only, then I will change it. Now first NCI will be how much? So can you say NCI is nothing but 25%, because your NCI will increase by, this is NCI and B Limited. This is NCI and C Limited. This is NCI in C Limited and this is NCI in B Limited. There are two NCI, NCI in C, NCI in B. You remember chain holding. In chain holding, we used to calculate two NCI. NCI in subsidiary and NCI in sub-subsidiary. So this is NCI in B Limited sub-subsidiary. Okay, sir. That is 25%. 25% of INA plus goodwill, because it is full goodwill. B Limited, it is full goodwill. So it is INA plus goodwill on the date of change. 25%. So what is the INA given? INA of B Limited 10 lakh. That is given, initially given 10 lakh plus goodwill how much given? 6 lakh into 25%, how much? It is 16 lakh into 25%, that is 4 lakh. That is 4 lakh. So NCI in B will be 4 lakh. Correct. Now what actually happened, just try to understand in this case. See, what is the consideration received? Consideration received is what? Once again, the business of what? Means if you effectively disposed of 25% of C Limited, so what you are getting? You are getting what? C Limited. You are getting C Limited now. You are getting C Limited. So in this case, the consideration will be what? The fair value of business. It is to the extent of 25% only. To the extent of 25%. Means you are getting 75%. Means you are getting the C Limited 75% at a worth of rupees 17,50,000. 17,50,000 for 100% of B Limited. But effective disposal is 25%. It means what is the effective consideration? So here the effective consideration will be debited and effective consideration will be 25% of 17,50,000. Yes or no? Understood. Once again, 17,50,000 we are receiving for 100% of B, but out of 100% of B, the effective disposal is 25%. That you need to understand. If you understood this, the solution is very easy, correct? So can you say we'll take 25% of 17,50,000, that will come actually 4,37,500 only. So that will be 4,37,500, and the difference will become other equity, and other equity will be how much? Other equity will be 37,500. 37,500. This is the journal entry. If you have understood this journal entry, the game is over. The game is over. Have you understood this entire transaction or not? Now you need to pass one compound journal entry. Means in exam you will pass one compound journal entry. So if you have understood this, can you say compound journal entry you can do? So what will be debited and what will be credited? Batao. So how much INA will be debited? INA account debit how much? Batao. That is 5 lakh. Goodwill will come how much? That is 62,500. And can you see this effective consideration and this effective consideration will be kata kata. This will be kata and this will be kata. This PC kata. Are you getting? Means whatever consideration you are receiving for the sale of B, effective sale of B, and whatever consideration you are paying for what? Acquisition of C Limited is 4,37,500 effectively. Correct now? That will be kata kata. Okay, sir. To what? To, can you say NCI in C Limited? How much? That is 1,25,000. Yes, sir. And how much NCI in B Limited? NCI in B Limited will be how much? 4 lakh. And to other equity. Other equity will be how much? 37,500. Just check whether your balance sheet tallied or not. Your journal entry tallied or not. It is 5,62,500 minus 1,25,000 minus 4 lakh, that is 37,500, and it is tallied. You can pass this compound journal entry in exam. You can pass this compound journal entry in exam. So what they have asked, let us read once again what was the requirement. Compute gain or loss on effective disposal of B Limited, that you have calculated. So this is one working note. This is the first working note. You can write down in the statement format 37,500. Then they have compute goodwill. So goodwill is what? This is the goodwill. So they have asked this. If they ask compound journal entry, this. If they ask consolidated financial statement, because in solution, even though the question they have not asked consolidated financial statement of A Limited, but in the solution they have given. Let us prepare CFS. CBS of A Limited. It is super easy. Means whatever CBS of A Limited is given, you need to only incorporate this particular journal entry. Let's see. What is the CBS of A Limited given before this transaction? This is the CBS. So goodwill is 6 lakh. So now goodwill will become 6 lakh plus 62,500. That is 6,62,500. Okay, sir. Then what is given after that? It is INA. INA means net asset. You can add on INA. So net asset. How much they have given? It is 11, means 1 crore 10 lakh. So 1 crore 10 lakh plus 5 lakh. It will become 1 crore 15 lakh, and this is the total. Then what is given? Equity share capital. That is what? It is 20 lakh. Equity share capital is 20 lakh. Write down share capital 20 lakh. Then they have given other equity including retained earning or whatever. It is how much? 96 lakh. So 96 lakh plus how much? So 96 lakh plus 37,500. It is 96 lakh 37,500. Then to NCI will come NCI in B and C. So B is what? 4 lakh and C is 1,25,000. So 4 lakh plus 1,25,000. That is 5,25,000. What is left? I think all points done. Balance sheet should tally. Just check the balance sheet. It is 1 crore 15 lakh plus 6 lakh 62,500 is 1 crore 21 lakh 62,500. This is 20 lakh plus 96 37,500 plus 5 lakh 25,000. Match 121 62,500. Super easy. In exam they may ask CBS also. Correct now. So if you now see the solution, you will be able to understand. Now let us come to the solution. You can see what they have given. Effective disposal of stake in B Limited is 25%. That you have understood. Then gain or loss on disposal. Calculation of NCI interest in B Limited in a consolidated financial statement. That is 4 lakh. Already we have done. Less fair value business received in consideration. Fair value business received. That is 25% of 17 lakh 50,000 they have done. This is a gain on disposal in equity. Chalega. Then goodwill on acquisition. What is the fair value business given in consideration? That is actually they have acquired 75%, but they have actually disposed of 25% of 17 lakh 50,000. So this is 25% 17 lakh 50,000. Then NCI is 1 lakh 25,000. Then INA is what 5 lakh. So this is what goodwill that they have calculated. Then they have given that compound journal entry. You can see INA 5 lakh, goodwill 62,500, NCNB, NCNC, and 2 other equity. Then they have prepared CFS. However, in exam, I will say only write down this. This much is not required. Why will do in this way? I will say this is not required. So this is 6 lakhs with same thing. Super easy. Then they have given some working note. This much working note was not required, but they have given computation of consolidated earning. You can also give computation of NCI. You can also do. Okay, sir. Super easy. This was a good question. Bolo. Have you understood this? Now come to the next question. Question number 13. However, this is similar to question 11. I don't understand why they have given 2 questions, but this is not a question of India's 28. So once again, the title heading is not correct. This question is related to India's 110. Means I don't know who is creating this type of question in RTP. From my point of view, any reading is not required, but let us read. H Limited purchased 100% subsidiary S Limited 5 lakh at the end of March 2003 when the fair value of S Limited net asset was 4 lakh. Means can you say the goodwill will be what 1 lakh? Goodwill is 1 lakh. H Limited sold 60% investment in S Limited in March 2005 for rupees 6 lakh 75,000, leaving H Limited with 40% investment and significant influence. At the date of disposal, the carrying value of net asset excluding goodwill was 8 lakh. So including goodwill it will be 8 plus 1 9 lakh. The fair value of investment in S Limited retained is proportionate to the fair value of 60% investment sold. Means can you say 6 lakh 75,000 is for 60%. So how much for 40%? You will do like this 6 lakh 75,000 into 40 divided by 60, that is 4 lakh 50,000. So this is the fair value of the retained investment. Compute a gain or loss on sale of 60% stake in S Limited for the purpose of separate financial statement and consolidated financial statement. Okay, separate financial statement, it has been sold for rupees 5 lakh. So you have sold 60% in 5 lakh. And what is the carrying amount of investment in separate financial statement? The total it was purchased at rupees how much? So sorry, my mistake. It was sold, 60% was sold for rupees 6 lakh 75,000. Fair value of consideration received. Fair value of consideration received. Okay. And the cost price of investment acquired of 100% was 5 lakh. Out of 5 lakh, 60% sold. So 5 lakh into 60%. So the average carrying amount of investment in separate financial statement which has been sold is 3 lakh. So what is the gain? Gain will be what in separate financial statement? That is 3 lakh 75,000. So this is the gain in separate financial statement. Okay, sir. Now they have also asked you to calculate gain or loss in consolidated financial statement. So what is 60% fair value of consideration received? That is 6 lakh 75,000. What is the fair value of investment retained? That is 4 lakh 50,000. Total become what? 6 lakh 75,000 plus 4 lakh 50,000. That is 11 lakh 25,000. Correct. And what is the carrying amount of net asset plus goodwill on the date of loss of control? The carrying amount is 8 lakh plus goodwill how much? 1 lakh, because it is 100% attributable to parent company. So this will be 9 lakh. 9 lakh minus, so 11 lakh 25,000 minus 9 lakh. What is the gain? Gain is what? 2 lakh 25,000 in CFS. Out of that, 60%, if you want to calculate separately for gain or loss on disposal of equity shares and gain or loss on remeasurement of investment, if you want separately, so this 60% belong to disposal of shares and 40% belong to what? Investment retained, remeasurement of investment retained. Very simple. Same answer has been given if you read question number 13. So 3,75,000 in separate financial statement and 2,25,000 in consolidated financial statement. Got this point? Now come to the next question, and the next question is related to India's 41 agriculture. The same question we have, or I will say similar question we have in ICA study material, but then also I would like to discuss the solution, because there is one additional information given in the question and there is one mistake in the solution. Okay sir, let us do this. A Limited purchased 100 gold at an auction of rupees 1 lakh on 30th September 2007. Subsequent transportation cost were 1,000. A Limited would have to incur the same transportation cost if it had sold its good in this auction. This transportation cost is incurred both by buyer and seller. In addition, there would be 2% auctioneer fee on the market price of the goods payable by the seller, but the transaction cost means auctioneer fee is only incurred by seller. A Limited so incurred rupees 500 on veterinary expense. This is one extra point. So this is a separate expense which will be charged to the profit and loss account of A Limited. So in this case, the initial recognition will be done at fair value less cost to sale. What is the fair value less cost to sale? What is the market price given? 1 lakh. Then from this we'll do minus 1,000 transportation cost and 2% is the auctioneer fee. It will become 97,000. But the amount of payment will be 1 lakh plus 1,000. The amount of payment you can see it is 1 lakh 1,000. 1 lakh 1,000. The first journal entry I just explained with the journal entry given the solution. The first journal entry is what? Let's see, biological asset account debit 97,000, correct? And the payment has been done 1 lakh 1,000. Therefore, there is a loss on initial recognition 4,000. I have seen the student normally write GOAT account debit. Don't write down in exam GOAT account debit, write down biological asset. If you want to write down GOAT, write down in bracket. So please write down biological asset. Don't write down only GOAT account. Okay, sir? Yes, sir. Then there is one expense. So that expense will be charged to PL account. So it is veterinary expense to cash or bank 500, 500. Both are already done. Now come to the next point. On 31st March, this is the reporting date. The market value of gold in the most relevant market increases to 1 lakh 10,000. Now the market price become 1 lakh 10,000. The transportation cost is 1,000, so minus 1,000 will do, and would have to be incurred by the seller to get the gold to the relevant market, and auction fee is 2%. So 2% of 1 lakh 10,000, 1 lakh 10,000 into 2% is equal to 2,200. 2,200. It will be 1 lakh 10,000 minus 1,000 minus 2,200. It become 1 lakh 6,800. Initial recognition was done at 97,000. So there is a gain of how much? There is a gain of what? 9,800. So your subsequent recognition will be done at 1 lakh 6,800. You need to record a gain. So gain will, the generate will what? Biological asset account debit gain, and that gain will be transferred to PL account. So biological asset account debit gain 9,800. Done. Yes, sir. Then what is given? On 1st June 2008, the entity sold 18 gold at an auction of rupees 20,000 and incurred transportation charge of 150. In addition, there was 2% auctioneer fee on the market price of the gold paid by the seller. It means nowadays the actual transportation cost and auctioneer fee. So 2% of 20,400. So your total expense is 150 plus 400, that is 550. So what is the net amount you have received? 20,000 minus 550. So 20,000 minus 550. So net amount you have received 19,450. What is journal entry for sale? Bank account debit 19,450. Selling expense you can write down, or transportation cost, auctioneer fee you can write down separately also, but you can write down selling expense is how much? 550, and to revenue will be what? 20,000. So this journal entry is correct. You can see, but can you see in this case we should also de-recognize the biological asset. We should also de-recognize the biological asset. That journal entry is missing. So what is the journal entry for de-recognition of biological asset? That journal entry is missing. Okay. If you see ICS study matrix, they have given that journal entry. Correct. So first I will say, if from my point of view we can pass this journal entry, biological asset will be de-recognized. Biological asset will be de-recognized. So we'll pass one journal entry, cost of sales, account debit to biological asset. This journal entry is missing. So what was the carrying amount on the last reporting date? That was 1,06,800. For how many got? 100 got. Out of that 18 sold. So what will do? 1,06,800. 1,06,800 into what? 18 divided by what? 100. Nah, it was 100 got na? Yes, I think yes, 100. Yes, sir. Correct. So divide by 100. So it is coming what? 1,06,800 divide by 100 into 18. So this will come 19,224. 19,224. So this journal entry we can do. And ultimately what you will do, if you will prepare profit and loss account, you can see that revenue is 20,000. Your cost of sale is 19,224, and you have a selling expense of how much? 550. So ultimately a gain means ultimately a profit of how much will be recorded? 20,000 minus 19,224 minus 550, and you can see 226 gain will be recorded with this SOPF. For that balance of profit we don't pass any separate journal entry. However, in ICS solution, if you remember, they have done a separate, means a different type of journal entry. Means instead of this, what you can do, first you can recognize gain on subsequent recognition, means on the date of de-recognition, means on the date of sale. If you just try to understand what they want to say. What is the market price now? The market price was 20,000, correct? The market price is 20,000. Transportation cost 400, and transportation cost plus auctioneer fees 550. So it will become 20,000 minus 550. It become 9,450, correct? And your the carrying amount is what? 9,224. So ultimately this gain is how much? Minus, you'll do 19,224, and the gain is 226. So first we recognize the gain, and we write on gain, we write on biological asset account debit gain 224, and ultimately biological asset will be equal to 19,450. Then we pass one more journal entry, cost of sales to biological asset 19,450. However, the net effect remains same, which you can pass this journal entry also. Gain biological asset account debit 226 to gain 226, and then cost of sales account debit 19,450 to biological asset 19,450. Means if you want to pass this journal entry, this is also correct as per ICS solution. That is your choice, whatever you want to pass. But that journal entry is missing in this particular solution. That is mistake in the solution, I will say. Okay, sir. Yes, sir. Then what is given? Then after that, whatever is given, it is as simple as what we have done in your ICI question. Means after that, no doubt will come. On 15 September 2008, the fair value of 82 goats were 82,820. This information is not relevant. 42 goats were slaughtered on that day. Means there is some what? Slaughtering of some of the goat. 42. With a total slaughtering cost of 4,200, the total market price of carcasses that become inventory after slaughtering, it will become inventory, on that day was 48,300, and the estimated transportation cost to sell the carcasses 420. Means what is the fair value less cost to sale of inventory? It is 48,300 minus 420, and there is no other expense, there is no transaction cost. So what is this? 48,300 minus 420, this will become 47,880, correct? And there is a slaughtering expense of 4,200. So we can pass one compound journal entry, inventory account debit at this amount, then we'll de-recognize the carrying amount of 42 goats, correct? Now, so what journal entry will do? Inventory account debit 47,880 to bank slaughtering expense 4,200, and the carrying amount of biological asset that will be de-recognized will be 1,06,800 into 42 by 100. So 1,06,800 into 42 divided by 100, it is coming what? 44856, and the difference will be gain and loss, that will be transferred to profit and loss account. Chalega. Then last journal entry will be what? Depending upon the last para. On 30th September, because it is given that the entity is preparing interim financial report on 30th September and 31st March. So there are two reporting dates, 30th September and 31st March. So on 30th September also we'll also do subsequent recognition, and the market price of remaining gold is 44,800 to 44,800. The transportation cost is 400 minus, and the auctioneer fee is 2%. So 44,800 into 2%, that is 896. So it will become 44,800 minus 400 minus 896. It is 43504. And what is the carrying amount? Carrying amount of 40 got whatever left. It is 1,06,800 into 40 divided by 100. That is 42,720. So once again there is a gain. Gain is how much? 43504. The gain is what? 784. This gain will be recognized at the end of the means on 30th September. The journal entry is what? Biological asset account debit to gain. Biological asset account debit to gain. But this, once again there is some mistake. You can see loss. How this loss came? God knows. Understood? Are you able to understand? Correct. So this should be actually gain. Gain journal entry what? What is the gain journal entry? So journal entry for the gain will be how much? 784. So this will be journal entry for gain. Biological asset to gain 784. This is also one mistake in the question. Okay, sir. Have you understood? Any doubt? No doubt? Chalo. Done. We have done the part. Solution is okay? Yes, sir. The two mistakes we have identified in the question, in the solution. Okay? Yes, sir. Then coming to the next question about Ind AS 28, investment in associate and joint venture. Let us read it. What is the question? Once again, good question. But this is related with Ind AS 28 mixed with Ind AS 102. So once again, the heading should be plus Ind AS 102 also. What is given? Beta Limited has issued 2,000 equity shares which were outstanding at the reporting date. Okay. So Beta Limited investee. It is an investee. On this date, Beta issued 1,000 share option to its employee, which can be converted into 1,000 equity shares of Beta. Okay. Means Beta Limited, there is one investee who has initially issued 2,000 equity shares, and then they have given 1,000 share option to its employee. The granted fair value of each option issued is ₹1. Okay. The option will vest over 5 years, and all 1,000 options are exercised to vest. So all 1,000 options are expected to vest. So all the options will vested. Beta recognized share-based remuneration expense of 200 in his profit and loss account and offsetting credit to equity in the current year. Means what they are saying, the expense. So expense will be how much, because the exercise period is, it will vest over 5 years. It is a 5-year vesting period. So what is 1,000 options into 1? This becomes the total fair value 1,000 divided by 5. So 1,000 divided by 5. So what will be your remuneration expense? Means what will be your share based payment expense? We can say EB expense. That will be 1,000 divided by 5. That is equal to 200. 200. They have given that only. So for this, we'll pass one generate EB expense account debit to SBP reserve. Alpha Limited investor holds 600 shares of Beta Limited. So 600 divided by 2,000. This will be how much? 600 divided by 2,000 means initially it is 30%. So they are holding 30%, means they are exercising significant influence, and therefore in the books of Alpha Limited, in the consolidated books of Alpha Limited, Ind AS 28 will be applicable. Alpha has significant influence over Beta Limited. Alpha recognizes share of remuneration expense in PL as a part of income from the equity accounted investees. Of course, can you say this EB expense will be charged to the profit and loss account of Beta Limited. So can you say the share of profit is always recorded in the books of investor as per India's 28. So that share of expense will be recorded. So share of expense will be recorded. So we can write down share of EB expense, to what? Investment account, to investment account. So in the books of Alpha Limited will pass one journal entry, share of EB expense to investment account, and investment will decrease by what amount? 200 into 30%, that is how much? 60 rupees. Yes sir. It record the offsetting credit as a reduction in his investment beta. Of course the investment account will be created. So journal entry is what? Share of EB expense. Normally we write down share of profit from associate or joint venture, but because here they have given only EB expense, I am writing share of EB expense account debit to investment in associate. Okay sir. Yes sir. At the end of the vesting period, all options vested and are exercised. The exercise price is ₹3 per option. The face value per share is ₹1. Pass journal entry in the books of Beta Limited and Alpha Limited for the recording share-based payment expense for the first year. That already I have said. In the books of Beta Limited, journal entry will be EB expense account debit to SBP reserve. In the books of Alpha Limited, the journal entry will be share of EB expense account debit to investment in associate with the amount 60 rupees. The first journal entry is very simple. You can see what journal entry they have given. In the books of Beta, share-based payment means EB expense account debit to SBP reserve 200, and then share-based payment remuneration. You can add on share of EB expense. So share of EB expense to investment in associate 60-60. Okay sir. Yes sir. Yes sir. The first point was very easy. Second point, pass journal entry for exercising the option in the fifth year. That is also very easy because SBP reserve at the end of fifth year will be 1000. So journal entry what? Bank account debit SBP reserve to equity share capital, and balancing figure will be securities premium. Yes sir. So what journal entry will be done? It is bank account debit. So they have said the exercise price is 3. So 1000 to 3. SBP reserve will be 1000 to equity share capital, because it will be 3000 plus 1000, and they have given the face value. Whether they have given the nominal value, I think they have not given. So I think they have assumed that the face value per share is ₹1, that is given. So it will be equity share capital 1000, and the balancing figure will be securities premium, that is 3000. So this journal entry is also super easy. Only the last point is interesting. I mean, this was easy. Point number 3 is interesting. In the books of Alpha Limited, compute a loss in dilution of shares of Beta Limited and pass journal entry for the same. Beta Limited has net asset totaling ₹11,000 immediately before the shares are issued. Correct? Now just try to understand what they want to say. Initially it was 30%. Correct? But now, because the number of shares will be how much? It will become 2000 plus 1000. Total will be 3000. Out of that, Alpha Limited is only holding 600 shares. So 600 divided by 3000. Now it will be how much? 600 divided by 3000. It means 20%. It means there is a dilution, but significant influence will be not lost. Means investees now also what? Associate. Means equity method will be continued. But 30% now become 20%. 30% now become 20%. Now immediately before this transaction, the net asset was 11,000. And due to this transaction, how much cash will be received? So you can see cash received is 3000. So your net asset will increase by 3000. Net asset will increase by 3000. So can you see it will become 11,000 plus 3000. How much? 14,000. 14,000. Got this point? So can you say 14,000 20% will be how much? So 14,000 20% will be 2,800. 2,800. Chalega. Means now what is the share of net asset in Beta Limited? That is 2,800 after dilution. And before dilution it was 11,000 ka 30%. 11,000 ka 30%. It was how much? That is 3,300. It means from 3,300 it will be diluted to 2,800. So how much reduction is there? 500 reduction is there. 500 reduction is there. It means we should reduce 500. But can you say when we have done the journal entry of share of EB expense, that time already we have diluted for the first year, second year, third year, fourth year, fifth year, 60 into 5. Means 60 into 5, how much? Means out of 500, already we have diluted, means already we have reduced the investment to the extent of 300. Means now we should only reduce 200. I hope you are understanding. Means due to share based payment transaction, already we have recorded one journal entry in the books of Alpha Limited by way of share of EB expense account debit to investment associate every year with an amount equal to 60 at the end of each year. So 5 years, 60 into 5 means already due to that transaction, how much we have reduced the investment account, that is by 200. So guys, due to this transaction, already reduction, how much we have done? 200. How much total reduction required? 500. Sorry, already we have reduced how much? 300. Total reduction is what? 500. So what is the balance reduction required? That is 200. We will pass one journal entry. Journal entry will what? Batao. What will be journal entry? So journal entry will what? We should reduce, we will say to investment 200, and that will be loss, and that loss will be transferred to profit and loss account. So loss on dilution 200. So loss on dilution account debit to investment in associate 200. Understood? Got this point? That is given by way of calculation. Alpha share of net asset before exercise 3300. Alpha share of net asset after exercise, that is 11,000 plus 3,000 into 20%, that is what? 2,800. Cumulative adjustment required 500. Adjustment previously recognized for share based payment transaction is 300. So what is the dilution required? The loss on dilution which is transferred to PL will be 200. This is the journal entry. Got this point? Understood? Good question. Means I will say these are all conceptual question. Means India's, they are mixing India's 28 with India's 102. India's 28 concept plus India's 102 concept. They have combined this. Means previously I have never seen this type of question in ICS study matter, RTP, MTP. So now I will say very simple. Once you have understood, now you can do this question. There is nothing heaviness in this particular question. But in exam, if immediately this question is asked, and if you have not done it, it is a difficult question. Am I right or not? Yes, sir. But you understood. Correct. So question number 15 also done. Now let us come to the next question. Next question is also very good question. Once again, new question. Question number 16. That is related to financial instrument, and this question is of embedded derivative. New question again. ZX issue a fixed rate loan for rupees 5 lakh and incur issue cost of 20,000, resulting in initial carrying value of 4,80,000, because of course this 20,000 will be deducted from this financial liability 5 lakh. Fair value is 5 lakh. Okay. The loan carries an interest rate of 8% per annum and is repayable at par at the end of year 10. Okay, sir. However, under the contract, ZX can call the loan money at any time after 4 years. Means after 4 years it can be redeemed. Means can is a call option means right to buy. Right to buy means right to redeem. So entity has a right to call, means right to buy back. Correct. It means can I say there is a one call option inserted, and therefore there is one embedded derivative. Now the question is that whether embedded derivative requires separation or not. So in this case, the host contract is the fixed rate loan in which the call option is embedded, and whenever the call option is not closely related with the host contract, then separation required. So we need to find out whether it is closely or not closely related. Got this point? Yes, sir. However, if you remember what I have said in the class, that if whenever question of embedded derivative comes and they require a question of separation, always assume, even though you are not able to understand, always assume that of course separation required, because if separation is not required, then it will be a simple question. Are you getting what I am saying? Yes, sir. By paying a fixed premium of 30,000 means if that call option is exercised, then the redemption amount will be 5 lakh plus 30,000. 5 lakh plus 30,000. However, if that call option is not exercised, then it will redeem at par at the end of 10th year. The fair value of the option is 10,000 at inception. The fair value of call option is given at the inception. The effective interest rate amounted to itna. Why effective rate of interest? Because there is a transaction cost. Yes, sir. Required. How is the embedded derivative? Embedded issuer only call feature accounted for by ZX issuer initially. So of course, can I say from the question, First, we need to identify whether a separation is required or not required. So I will say always in exam assume that they are not closely related and therefore separation required and therefore separation required. So if you remember, I have given one formula कि proceed received will be equal to fair value of post contract minus fair value of call option. Because can you see in this case the entity is the holder of call option, therefore they will need to pay some consideration to the writer. So they are receiving some amount for the host contract and they need to pay the fair value of call option to the other party. Therefore the net amount is the proceed received, and the initial proceed received is 4,80,000, correct, is equal to fair value of host contract minus what is the fair value of call option, that is 10,000. What is the fair value of host contract, that is 4,90,000. 4,90,000 is the fair value of host contract. This is the first point. So of course separation required. For that I don't think so you should write down much. However, I will read down the answer also if you want. But from examination point of view, always whenever they have given a question of embedded derivative, always assume that separation required. Don't assume by our own that separation is not required. Okay sir, yes sir. So first journal entry what? The journal entry is what? Cash account debit 4,80,000. Correct. Then derivative financial asset call option is what? 10,000, and to financial liability, or you can write down the loan, whatever. If you want to write down financial liability 4,90,000, this will be your first journal entry. You can see they have given the first journal entry, derivative financial asset 10,000, cash 4,80,000, and debt instrument, or you can add on financial liability 4,90,000. Okay sir. So this become the initial fair value of host contract, and this is with this amount we'll find out the amortized cost at the end of each year. Then what is given in the question? Explain the accounting of the loan when in the year 1 and year 2 there is no change in the interest rate since inception for an instrument of similar maturity and credit rating. The option fair value, that is time value, at the end of year 2 is 6,000. Means at the end of year 1 there is no change in the fair value of option, but at the end of year 2 it becomes 6,000. Means initially at y0 it was 10,000, at y1 it was still 10,000, but at y2 it becomes 6,000. Okay. At the end of year 3 the interest rate have fallen and the option fair value increases to 9,000. So at year 3 the fair value of option is 10,000. 9,000. It is 9,000. I am just first writing all the information, then I will say about journal entry. Then at the end of year 4 interest rate have fallen further and the option fair value increases to 20,000. So now option fair value at year 4 is 20,000. Okay sir. And the entity decided to repay the loan at the end of year 4. It means the repayment is done at the end of year 4 only. It means the repayment will be done at premium, that is 5,30,000. This is understood. This is the entire question. Now can you say first we need to find out amortized cost table based on 4,90,000 by applying effective rate of interest, that is 8.30213%. So you can see they have first prepared one amortized cost table to find out the amortized cost at the end of each year. 4,90,000 interest expense at 8 point means EIR. Then cash payment will be at contractual rate of interest means 8% of 5 lakh, that is 40,000, and closing amortized cost they have calculated. Means at the end of the 4th year, what is the amortized cost? 4,93,080. Correct? Got this point? Correct. Now they have not done journal entry of interest expense and cash payment. If you want, you can do also journal entry of interest expense and cash payment. So interest expense account debit to financial liability, then financial liability to cash or bank, you can do for the 4 year. Correct. Now they have given the journal entry only for the fair value of option, and that too they have done journal entry of only year 4. Correct. So what they have asked, you can see, explain the accounting of the loan. They have given explain. So they have done explanation in para format, but you can do the journal entry. So can you say at year end 1, you can do journal entry of interest expense and cash payment, that you can do, and there is no changes, so no journal entry for call option. There is no changes in the fair value of call option. Then at year end 2, that interest expense and cash payment, that journal entry you can do by your own. I am not saying anything about that journal entry. But now you can see 10,000 becomes 6,000. So there is a loss of 4,000. So what journal entry will do? PL account debit to derivative financial asset by 4,000. So there is a loss of 4,000. Okay. Then there is a gain of 3,000. What journal entry will do? Derivative financial asset account debit to gain, and that gain will be transferred to profit and loss account 3,000. Then again there is a gain of what? 11,000. What journal entry will do? Derivative financial asset account debit to 11,000 to gain 11,000 transfer to profit and loss account. So now the derivative financial asset will become 20,000, and at the end of fourth year we'll do the repayment journal entry. So what journal entry will do? Financial liability. What is the carrying amount? Carrying amount how much? As per amortized cost table, that is 4,93,080. It will be 4,93,080. Then to derivative financial asset, it will be 20,000. How much repayment will do? Repayment is what? Cash 5,30,000. 5,30,000. Understood? So what is the loss here? 5,30,000 plus 20,000 minus 4,93,080. What is the loss? Loss is what? 56,920. This is loss, and this loss will be transferred to profit and loss account. This is loss due to repayment. Understood? Got this point? Yes, sir. Let us see the last journal entry. So last journal entry you can see 4,93,080, 56,920 loss on derecognition of liability, and 20,000 and 5,30,000. Correct? Super easy. But then also good question. Once again, new question. I will say whenever you are conceptually strong, you can do it. I have said in the initial when I started the RTP discussion, I said all questions are new. But if you are conceptually strong and you have understood the information given the question, all answers are very easy. Only I would just like to discuss about one point. They have given one clarification about whether separation required or not required. So what is given? It is first necessary to determine whether the call option is closely related to the host debt instrument, because the fixed premium is required to be paid whenever the call option is exercised after year 4. It is not known. It will be equal to the present value of any interest loss during the remaining term of exercise of the option. Means whatever premium paid, whether it is equal to the present value of interest loss. If that is the case, then it is closely related. Additionally, the call option exercise price is 5,30,000 inclusive of premium. Therefore, it is unlikely to be approximately equal to the debt instrument amortized cost in year 4. You can see the amortized cost is equal to 4,90,000 some amount. It means that are different to it. From this we can understand that they are not closely related. So hence separation is required. If you write on this much, then you don't write after this and give one conclusion. Give one conclusion at the end. From this entire explanation we can conclude that what you can conclude that call option and the host contract is not closely related, and thus whichever way the options are viewed, the embedded derivative need to be separated. This is the conclusion part. Okay sir, chalega? Yes sir. Good question. Any doubt? Okay sir. Now come to the next question. The next question is of Ind AS 21. I always used to say this type of question can be asked. This is related to Appendix B of Ind AS 21. Once again, good question because it is a new question, but similar question we have in ICS study material. PQL Limited has entered into a fixed price contract on 1st Feb 2002 to provide annual maintenance service worth $10,000, which is rendered uniformly throughout the year over a period of 2 years. 1st Feb 2002, the contract has been done, and means the contract has been done on 1st April 2002, but the service will be rendered on from 1st April 2002 to 31st March 2024 to a foreign customer. As per the terms of contract, it has received advance payment of 3,000 on 1st Feb, and balance is to be received on 31st March 2024. The entity recognizes revenue at the end of every year. How should the entity account for the said transaction? whether consideration received in advance. So this is actually a theoretical question because they have not given the exchange rate. So I'll just explain the question. We are doing question number 70. You can see 1st Feb 2002, 1st Feb 2002, this is 1st April 2002, this is 31st March 2003, and this is 31st March 2004. Now contract has been done of $10,000 यहाँ पर. Out of that $3,000 received and revenue will be recognized for this year. Out of that 10,000, $5,000 revenue will be recognized at this point of time. $5,000 revenue will be recognized at this point of time, and $7,000 will be received at this point of time. Okay, sir. This is the entire question. Am I right? Yes, sir. Chalo. Now just try to understand. Let me explain with the exchange rate. Suppose the exchange rate is 80 at this point of time, then 81 at this point of time, and 82 at this point of time. So on 1st Feb 2002, we'll pass one journal entry. We have received one advance. Freedom bank account debit to contract liability, and 3,000 into 80 will do. So 3,000 into 80, how much? That is 2,40,000 will be recognized as a contract liability. Why contract liability? Because revenue cannot be recognized on this date because performance obligation is not satisfied as per Ind AS 115. Then on 31st March 2003, out of 10,000, 50% will recognize as revenue because 50% performance will be completed. Got this point? What journal entry will do? We'll say contract liability account debit, correct? Then trade receivable account debit to revenue. So it is what? 3,000, and this will be 2,000. Now the question is that what will be the exchange rate? So for this 3,000, because this is a foreign currency, this contract liability will be actually, because this is advance. So this is what? One type of foreign currency non-monetary item. So foreign currency non-monetary item, there is no restatement, no translation required. So this will be at 80 only, and this will be 2,40,000. But is a trade receivable, and this will be initial recognition of that. So we will recognize at 81. So 2,000 into 81, how much? That is 1,60,000. And your revenue will be how much? 1,60,000 plus 2,40,000, that is 4 lakh. Your revenue will be 4 lakh. Correct. Then again, on this date, on 31st March 2004, what journal entry? Again, trade receivable account debit to revenue will do. That is 5,000 into, so can you see it is 82, so we recognize that 82 only, and revenue will be also what? 5,000 into 82. Got this point? So 5,000 into 82, how much? 4,10,000. 4,10,000. Correct. Now out of this entire amount received, so we'll say bank account debit to trade receivable. So trade receivable will be how much? It is 1,60,000 plus 4,10,000. 1,60,000 plus 4,10,000 means 5,70,000. 5,70,000. Correct. But can you say this 2,000 was recorded at 81, but now amount received will be based on 82. So what will do? 2,000 into 82 plus 4,10,000 will get. So 2,000 into 82, how much? 1,64,000 plus 4,10,000. So amount received will be 5,74,000, and there will be an exchange gain. So exchange gain transferred to profit and loss account will be 4,000. This will be the answer. Got this point? This answer has been given in theoretical way. Means if you read the answer, come to the answer. What is given? I'll just read on your behalf. If the advance received from the customer is determined to be in the nature of prepayment or progress payment, these are treated as non-monetary item. I have also said foreign currency non-monetary item. Accordingly, in the instant case, PQR received the advance payment of $3,000 on 1st Feb, which it translate into functional currency using the exchange rate on 1st Feb only. Applying Ind AS 21, and it does not update the translated amount of the non-monetary liability. That already I have said. Applying Ind AS 15, revenue from contract with customer, recognize revenue over a period of 2 years. Since the entity recognized revenue at the end of the year, revenue of 5,000 will be recognized at the end of first year. PQ has determined that consideration of 3,000 related to the service it has rendered in the first year. At the end of year 1, the entity is entitled to unconditional right to receive $2,000 for the remaining consideration. Accordingly, at the end of first year, on 31st March 2003, it recognized revenue of 5,000, out of which 3,000 will be recognized by de-recognizing the contract liability, and no exchange fluctuation will be involved. Balance of 2,000 revenue will be recognized by translating the exchange rate at the date of transaction. That only I have said. Correct. It will update the translated amount of this receivable until the receivable is settled on 31st March 2004 and recognize the corresponding gain or loss in PL. At the end of second year, 31st March 2004, it recognized the balance revenue of $5,000 using the exchange rate at the date of transaction. Same thing is given in theoretical way. So if the same questions come, you can't write down as per my journal entry. You need to write down as per this theoretical answer. So if you have understood by way of journal entry, you can write down in your own words in the para format. Yes sir, chalega. Yes sir. Okay sir. Got this point? Now next question is Ind AS 7. The same question we have in our question bank. Okay. It is very simple what is given. So if you want, I can do it again. A Limited, whose functional currency is Indian rupee, had a balance of cash and cash equivalent of 2 lakh but no trade receivable or trade payable on 1st April 2002. So they have an opening cash and cash equivalent of 2 lakh with 0 trade receivable and 0 trade payable opening. During 2002-2003, A Limited entered into following foreign currency transaction. Okay. A Limited purchased goods for resale from Europe for euro 1 lakh when the exchange rate was 1 euro is equal to 105. Okay, sir. The balance still unpaid at 31st March 2003 and the exchange rate is 100. You can see here 105 become 100 and the balance still unpaid. So because it is a foreign currency monetary item, whatever the creditor is there, there is a foreign currency monetary item. It will be translated by using closing exchange rate. So there is a gain of what? 5. So what will do? 1 lakh into 5. So 5 lakh gain will be recognized. But can you say this will be an unrealized gain? Unrealized gain. Yes, sir. Then A Limited sold the goods to an American client for $1,50,000 when the exchange rate was $85. $1 is equal to 85. This amount was settled when the exchange rate was 87. So here it is realized. So there will be realized gain. So realized gain will be 1,50,000 into 2, that is 3 lakh. Realized gain, exchange gain, this is realized gain. Okay, sir. A Limited also borrowed euro 1 lakh under long-term loan arrangement when the exchange rate is 105 and immediately converted into rupees 1 crore 5 lakh. Understood? And can you say in this also there will be one, because this is also one type of foreign currency monetary item, will be translated by using closing exchange rate, and the closing exchange rate is 100 only. It is given here. Same thing will be applicable. So here also 1 lakh into 5, that is 5 lakh is the unrealized gain. Means total gain is how much? 5 lakh plus 5 lakh plus 3 lakh. 13 lakh is the 13 lakh is the exchange gain which will be transferred to PL. Recommend how the cash flow arising from the above transaction will be reported in the statement of cash flow under indirect method. Understood? Now in this case, first we need to find out what is the profit. If you see, the goods sold is what? Means when the sale has been done, it was 1,50,000. The sale has been recorded at 85. So 1,50,000 into 85, how much? That is 1 crore 27 lakh 50,000. This is 1 crore 27 lakh 50,000. And the cost of sales will be 1 lakh into 105. So 1 lakh into 105, the cost of sales will be 1 crore 5 lakh. It is 1 crore 5 lakh. Okay, sir. चलेगा. तो 1 crore 5 lakh is the cost of sales. So what is the profit? Profit is what? 1 crore 27 lakh 50,000 minus 1 crore 5 lakh, that is equal to 22 lakh 50,000. So 22 lakh 50, correct? 22 lakh 50,000 is the profit. This is the profit, and there is an exchange gain of how much? 13 lakh. So 13 lakh is the exchange gain. So your profit before tax will be how much? 35 lakh 50,000. So we can start from this. So how to prepare now cash flow statement, that I need to explain. Okay, this will be a part of working note. This will be a part of working note. Now how to prepare? We will prepare cash flow statement. Cash flow statement. And we write down cash flow from operating activities. So first we write down cash flow from operating activities. What is your profit before tax? The profit before tax is 35 lakh 50,000. Okay, understood. Now there are, just try to understand, there is some exchange gain, and there is one exchange gain related to what? The exchange gain related to financing activity, and there is one exchange gain related to operating activities. Means there are three exchange gain. The realized exchange gain, can you say no adjustment required? Doubt will come for unrealized exchange gain. Unrealized exchange gain. So what we should do? Any unrealized exchange gain of financing activities should be eliminated. Should be eliminated means how much it is? 5 lakh. So that will be eliminated. So what we'll do? Means I'm just explaining as per ICS solution. Okay. So unrealized exchange gain related to financing activity, because operating activity it will be automatically adjusted. Got this point? Are you able to understand? So what is the unrealized gain of financing activity? That is 5 lakh. So we'll do plus unrealized, sorry, minus, my mistake. It is gain minus unrealized exchange gain related to financing activity is 5 lakh. So this will become how much? 30 lakh 50,000. Correct? Understood. Now this will become cash generated. This will be what? Cash before working capital changes. Now can you say, because there is one trade payable, and trade payable opening balance 0, but there will be some closing balance, so we will find out increase in trade payable. We will do plus increase in trade payable. So initially it was nil, opening balance nil, and closing balance will be equal to how much? That is 1 lakh into 105. Sorry, 1 lakh into 100. So 1 lakh into 100. 1 lakh into 100. So 1 lakh into 100. That is how much? It is equal to 1 crore. Na? It is equal to 1 crore. We will add increase in trade payable 1 crore. 1 crore will be added. So this will be cash flow from operating activities. That is 1 crore 30 lakh 50,000. Okay. Now we'll do point number 2. Cash flow from investing activity. That will be nil. Then point number 3 will do cash flow from financing activity. Financing activity. So how much amount we have received initially? That is what? 1 lakh into 105. So 1 lakh into 105. That is how much? It is 1 crore 50 lakh. It is 1 crore 5 lakh. Sorry. 1 crore 5 lakh. So this become net changes, means this is the increase in cash and cash equivalent during the year. So this will be 130 1 crore 30 lakh 50,000 plus 1 crore 5 lakh. The total will be what? 2 crore 35 lakh 50,000. Acha, this is okay, sir. Any doubt? Now we'll do plus opening cash and cash equivalent, that is given 2 lakh. So what is the closing cash and cash equivalent? That will be the sum total of these, that is 2 crore 37 lakh 50,000. This will be the answer. Any doubt? Have you understood this? Let us check the answer. Check the answer. You can see 2 crore 37 lakh 50,000. Exactly same. Exactly same is coming. Okay. Very good question. All the questions are given of good quality. Okay. You can see profit. This is 35 lakh 50,000. We have calculated. Then foreign exchange gain on long-term loan 5 lakh eliminated. Then decrease in trade payable. Decrease in trade payable means they have done this actually in two amount, but I have to ignore that. Means 1 crore 5 lakh and then minus 5 lakh. It is nothing but equal to 1 crore. You can see what I have done. I have done just directly 1 crore. You can follow my solution. You can follow my solution. Okay. Or if you want to do in this way, you can do in this way. So your choice. Okay, sir. Okay, sir. Then this become net cash flow from operating activities. Then cash flow from financing activities. This is net increase in cash and cash equivalent. This is opening cash. This is closing cash. And for closing cash, they have given one working note also. The opening is this. Then receipt from settlement of trade receivable, this amount. Then receipt from conversion loan, this amount. So this will be the closing cash and cash equivalent. One working note is not required, but if they have given, you can also do it. Chalega. So with this, we have also completed question number 18. Okay, sir. Now come to the next question. Next question is based on Ind AS 116. Okay, good question. Again, good question, but simple. The question of remeasurement. Okay, but I will say a new question. Question 19. Wealth Limited has entered into a lease agreement with the lessor for a period of 5 years at an annual lease rental of 8 lakh. Okay, sir. There is an option at the end of the said period. At the end of said period means 5 years that the lessee can own by the lessee. Means that there is a purchase option. Other factor to be noted are a discount rate. Other factor to be noted are discount rate 8% per annum. And interest rate implicit in the lease is 10% per annum. You can see now they have given two discount rate. One is 8% might be incremental borrowing rate of lessee, and 10% is the interest rate implicit in the lease. You only say which discount rate will be applicable. In this case, whenever interest rate implicit in the lease is given, then that is applicable. So this is not at all relevant. This is also one good point, which is still not given any question of ICS study material. So 10% will be applicable. Okay, sir. Wealth Limited is reasonably certain to exercise the option to purchase the lease asset at the end of lease term, and therefore 56 lakh is the exercise price agreed in the lease term for purchasing the land at the end of 5th year. So 56 lakh is the option purchase price, and because the lessee is reasonably certain to exercise the purchase option price, therefore it will be added to the lease payment to find out lease liability. Yes, sir. Therefore the same has been considered in computing the present value of lease liability. Okay, sir. Correct. At the end of 3rd year, Wealth Limited exercised the option to purchase the land at a value of 56 lakh. Can I say option was actually given to exercise at the end of 5th year, but they have exercised the option at the end of 3rd year. So this is known as what? Remeasurement. Means this is the changes in the purchase option availment. Are you getting what I am saying? This is known as remeasurement of lease liability. So we need to apply the concept of remeasurement. Whereas the market value on that date is 75 lakh. This is not at all relevant. Okay. For revised discount rate, consider the interest rate implicit in the lease. Of course, if you remember, whenever there is remeasurement, and remeasurement is because of purchase option price, then we will use revised discount rate. So for revised discount rate, they are saying consider the interest rate implicit in the lease, that is 10% only. Correct? Required, calculate the lease liability and ROU asset for the lease with the lesser ROU is depreciated on an SLM basis. This first point is very simple. We can find out lease liability, that is the present value of lease payment including purchase option price discounted by using 10%. That we can do it. So I am just explaining with the solution. Chalega? You can see they have given the lease liability calculation. So that will be equal to first year 8 lakh, 8 lakh, 8 lakh, 8 lakh. First 4 year and the last fifth year it will be 8 lakh plus 56 lakh. Discount rate at 10%. You can find our present value. This will become the present value. Correct. So this will be lease liability as well as ROU asset. So can you see ROU asset will be depreciated in 5 years. So 65 lakh 09 600 divided 5. Correct. So because can you see here it is here the lessee is reasonably certain to exercise the purchase option. So can you say ownership will be transferred at the end of lease term. So normally it should be amortized over the useful life, but the useful life is not given, so we are assuming lease term and useful life are same. But suppose useful life is given, so you should calculate depreciation based on useful life, not based on lease term. Got this point? I hope you are understanding this point. Chalega? Correct. So we'll do divide by 5 and depreciation will be equal to how much? 13 lakh 1920. So 13 lakh 1930. And similarly, can you see we need to find out the interest expense. So interest expense will be how much? 65 lakh 9600. So interest expense at a rate of 10%, that will be 6 lakh 6 lakh it will be how much? 6 lakh 50,960. Correct? This will be how much? 65 lakh 09,600 into 10% plus minus equal to minus 8 lakh. So what is the closing balance? Will do minus 8 lakh. So closing balance will be equal to 63 lakh 60,560. This is the closing balance at the end of 1 year. Chalega? This I am doing for the next question. What is the next question? They have given provide the amount reflecting the balance sheet PL and a statement of cash flow. Can you see in the balance sheet ROU asset will come at closing balance. The closing balance will be equal to this minus depreciation, that will be this amount, and in SOPL depreciation will come this amount. Correct? And lease liability in the balance sheet will be this amount, that amount already we calculated, and the interest expense of this amount will come 6,50,960 as per working note. Working note we can do separately. And in cash flow, what Ind AS 116 says that whatever lease payment you are paying, that include two components. One is interest component, one is principal component, and both will be considered as cash flow from financing activity. Therefore, it will be cash flow from financing activity. How much? 8 lakh. However, you can segregate into part. Interest component is how much? That is 6 lakh 50,960, and balance will be how much? 6 lakh 50,960 minus 8 lakh, that is what? 1 lakh 49,040. So this is interest component, interest payment, and this is the principal reduction. Got this point? Yes sir, chalega. This is also very good point. Then what is the last point they have asked? What is the accounting entry if the wealth limited decided to purchase the lease property at the end of third year? So okay, the first we need to find out calculation of the closing balance of lease liability at the end of third year and calculation of ROU asset at the end of third year. For that, one working note is required. So you can see they have also done the one working note. Working note is done how much? This is a closing balance of lease liability. This is a closing balance of ROU asset. Chalega? Correct. Now at the end of third year, means on remeasurement, can you say we need to compare lease liability with the revised liability, but revised liability will be amount equal to the purchase option price, that is 56 lakh. You need to now pay 56 lakh. However, your liability was 60 lakh 16,278. So how much reduction in liability? It is 60 lakh 16,278 minus 56 lakh. Your liability will reduce by 4,16,278. So this will be known as adjustment to ROU asset. So one journal entry will do lease liability to ROU asset, and your ROU asset will decrease and your lease liability will decrease by 4,16,278. You can see they have done first journal entry lease liability to ROU asset, and now your ROU asset will be equal to, can you see this amount? this amount plus 4 lakhs, this amount minus 4 lakh 16,278 minus 4 lakh 16,278, and lease liability will be equal to 56 lakh. Then we'll do the payment. Payment will be what? Lease liability account debit to bank. You can do the second journal entry they have done, lease liability account debit to bank. And can you see, we'll pass one more journal entry because now RU asset will become PP at an amount equal to this amount. So we'll pass one journal entry, PP account debit to RU asset with the same amount. Same amount means what? This minus this. So this amount is coming how much? 26,03,840 minus 416,278. That is equal to 21,87,562. Got this point? Good question, super question, I will say. But it is simple. Once again, all questions are simple, but all questions are new. So if you have understood the information given the question and you are conceptually strong, you can do it. That I just want to say. Now coming to the last question, descriptive question, that is related to share-based payment. This is also a good question. This is the share-based payment with cash alternative, but the option is with what? The entity, not with the holder. So in ICS study matter, there is no question related to this, but it is very simple. You can understand. Question number 20. Max Limited enter into a share-based payment arrangement with his employee on the following term. Each employee will receive 500 shares if they remain employed for a period of 5 years. Okay, sir. 500 shares and the service condition is 5 years. It is expected that no employee are expected to leave during the 5-year period. Okay, yes, sir. Means all the employee will vest the option. The grant date fair value of award is 4,000. Okay, sir. So it is given the total fair value of the award. If an employee leave Max Limited after the 5-year period, if an employee leave Max Limited after 5-year period, means after vesting period, but before his shares are listed, before listing of shares, the entity has an option to purchase the shares for fair value from the employee. Means can you see, then the entity has a choice to repurchase the shares. Means can you see, then it will become one type of cash settlement, but that will depend upon, because the entity has an option. It means it is SBP with cash alternative, but the option is based on the entity choice. Okay, sir. Yes, sir. On grant date, Max Limited expect to list in the list expect to list in the next 3 to 5 years. So Max Limited is expecting that it will be listed within 5 years. Okay, this is the first share-based payment plan, and Max Limited has no past practice or stated policy of buying back shares from the employee when the employee leaves. Neither does the Max Limited expect that it will settle the award in cash. So if you remember what we have discussed in our class, whenever there is a SBP plan with cash alternative and the option is with the entity, then it depends upon the intention of, it depends upon what is the intention of the entity. So there is no past practice, and of course there is no intention of the entity to settle in cash. Therefore initially it will be considered as equity settled. So it will be equity settled share-based payment transaction. Okay, sir. At the end of year 2, Max Limited on longer expect to list. Max Limited on longer expect to list, and the employee informed of this fact. Max Limited announced to employee that if it is not listed after 5 years, and the employee leave, Max Limited will repurchase the shares. The fair value of shares is 6,000 on this date. It means now what they are saying, Max Limited no longer expect to list. So now Max Limited is expecting that it is not going to be list. It is not going to be list. Can you say the employee, means the entity has an option to repurchase it, and the employer informed of this fact. Max Limited announced to the employee that if it is not listed after 5 years, and the employee leave, Max Limited will repurchase the share. Means can you say now it will reclassify from equity settled to cash settled share-based payment transaction. Got this point? At the end of the year 3, means at the end of the year 2, the fair value 6,000. At the end of the year 3, the fair value liability has increased to 9,000. Okay, sir. First, required, determine the accounting entry for year 1, year 2, year 3. It is very simple. Year 1, what is journal entry? EB expense to SBP reserve, because initially it was equity settled and it was the fair value was 4,000, vesting period was 5, so 4,000 divided 5 means 800. Correct. Can you see year 2, once again will pass EB expense to SBP reserve. First we will do this journal entry 800, but now at year end 2 we will do reclassification, because now SBP reserve will become what? SBP reserve will become SBP liability. So SBP reserve will be debited 1600, but SBP liability will be calculated as fair value at year end, that is 6,000. So 6,000 into 2 by 5, how much? 6,000 into 2 divided by 5, it is how much? 2,400. And balance will be considered as EB expense, and EB expense will be 800. However, this journal entry is not given correctly in ICS solution. Means if you see what they have done, first journal entry is correct, second journal entry is correct, but this journal is wrong. They have done SBP reserve 2,400, but it should be 1,600, and the difference will be EB expense. So there is one mistake in the solution. Chalega? Got this point? Yes, sir. Then at year 3, once again become 9,000. So what journal entry will do? Year 3, we will say EB expense to SBP liability, and it will be 9,000 into 3 by 5 minus 2,400. So 9,000 into 3 divided by 5 minus 2,400 means by 3,000. We'll do this journal entry with 3,000. I think same journal entry is given in the solution also. You can see it is by 3,000. The first point has been done. Super easy. But all questions are super interesting. Maza aa gaya. Means with this RTP for the first time, I personally want to say that any RTP means in the history of any examination, the RTP is of this nature. In this RTP, most of the questions are new and all are conceptually based, but not difficult. I will say not difficult. If your concept is strong, you can do it. So this type of RTP, this type of question is asked in exam. It is a true check of the student whether they are doing rectification or whether they are doing conceptual studies. Chalega? Yes, sir. But I am not happy with the solution of the second part. What they are saying, what will be treatment of the award if at the end of year 2, Max Limited does not inform the employee that it will repurchase the shares after 5-year period, and a listing of entity shares is still achievable. It means, can I say, no information has been given, so there will be no change. There is no change. And therefore, can I say, for the 5-year will pass journal entry with 800, 800, 800, 800, 800. But at the end of year 6, Max Limited has not yet listed and 2 of the employee leave. Max Limited exercise its settlement choice and buys the leaving employee shares at fair value. So this will be journal entry of buyback. Means, can you say, once the options are vested and suppose they exercise it, right now they have not given information about whether the employee has exercised it or not exercised it. But can you say this will be journal entry of buyback? So that is the buyback journal entry. Understood? For that only you need to give a note that this will be the buyback of equity. Buyback of equity, because no information has been given. So from my point of view, this should be solution. But if you read the solution, I am not happy with the solution what they have given. I don't know what they have given. The settlement of the 2 employee award may create a valid expectation in the mind of remaining employee that they will also receive cash when they leave. However, judgment will be required to determine if an isolated transaction established past practice resulting in a cash settlement obligation for Max Limited. Depending on any contrary fact, Max Limited should treat the remaining award as carry bakwas hai. Because I already given that buyback means it was listed what they have given at the end of 6th year. This information was available at the end of year 6. But they are assuming that this information is available at the end of year 2. How it is possible? So I will say, if the first para if you read, so it means there is no change and it will remain SBP reserve. Then if suppose after the vesting period, during exercise period or after exercise, the shares are not listed and the 2 employee left, so then buyback option is available. Buyback option means that buyback journal entry done by the entity as per the respective Ind AS. Got this point? This is the my solution. But believe me, super RTP. Super RTP means if this type of question they are going to ask in exam, tab maja aayega. So don't worry about that. But what I want to say, if you are conceptually strong, and if you know, if you have understood the information given the question, you can link the concept with the information and you can do it. Once again, I am saying that no question was difficult. Only the one question, if I say that Ind AS 101, that A limited, B limited, C limited, that question was thoda sa interesting. Apart from that, all questions were good. Good means good quality, but not difficult. I hope you have understood. In the next part, we'll do the MCQ based question also. Till then, you enjoy your preparation. All the best for your examination. In the comment box, just message me how you find the questions. Means from your point of view, these all questions are interesting, or you consider it as a tough questions, or you consider it as an interesting question. Means you want this type of question in exam, or you don't want this type of question in exam. Just comment in the comment box. All the best. Love you all. Bye bye.